And time now for our home loan segment. We are joined by Sanjay Athalye, CMO and CRO, Reliance Commercial Finance and Home Finance. Sanjay, pleasure to have you with us. Sanjay, let's get straight to the questions we have coming in. Anvesh is here with a question for you. Anvesh, go ahead.
Yeah, hi. Actually, I want to buy a resale flat in a leading property investor over here in Bangalore in Whitefield. But the land is Ekhata land, but the apartment has not received occupancy certificate and the completion certificate, due to which SBI is not sanctioning the home loan. However, when I checked with the private banks, with ICICI and others, they told that OC and CC, occupancy and completion certificate, is not mandatory for home loan, saying that 70% of the flats in Bangalore do not have OC or CC. In this case, should I go ahead with private banks or shall I step back? Because in this case, if I go with private banks, I do not have any other options. The builders which are providing OC and CC, either they have very high priced apartments are there, or the apartments are located outskirts of the city.
Okay. All right. So, Sanjay, let's take up this query from Anvesh. Occupation certificate not available on the property he has selected. Should he be going ahead and getting a loan on this property if there are lenders who are willing to do so?
Okay, a slightly tricky question. So basically what happens is every bank has its own policy, and accordingly they decide whether loan should be given on such properties or not. The documents that you're talking about are the occupancy certificate and the completion certificate, which obviously are mandatory documents as far as the property's completeness is concerned. When you buy a flat, you need to make sure that the property has a clear title, the builder has a right to sell it to you, and your title will be clear in turn. So these two documents go a long way in deciding that. There are banks who do give home loans without these documents, and there are some who insist that these documents be present. However, from my long experience in this business, I would advise that it is in your interest that you obtain both these certificates. Since especially you said the property is completed in 2011, which is 5 years already, the builder should have definitely got these documents. I would recommend that you look for properties where both the documents are available, because they have to do with the safety of your title and the future chance of anything going wrong in the absence of these documents. So I would suggest that you look for properties which have both these documents in place and accordingly take a loan. Additionally, because you said this property was, loans were given on this property at the pre-launch section, I would like to add that there are a lot of financial institutions who grant loans when the project is at a pre-launch station. That is with the condition that when the project is complete, you will get the occupancy certificate as well as the completion certificate. In this case, the project is already completed 5 years back. Hence, that condition is no more applicable, and it is still advisable that both the documents be insisted upon.
Okay, let's take up this next question from Sunil P. Hi Sunil, go ahead.
Hi, my question is regarding a home loan. I just wanted to know, is it beneficial to have a pre-approved loan from a bank or a financial institution, and what benefits does it have, or if it does not have any special kind of a benefit?
Okay, Sanjay, what should be Sunil's top checklist when applying for a home loan? A pre-approved loan, will that work?
First and foremost being the builder himself. Who is the builder? What is the project? How many projects the builder has done in the past? What has been his track record? Is it a complete property? Is it an under construction property? Those are the primary things that you look at. However, once you zero in and finalize what property you to buy, it is always advisable that you take a pre-sanction, that is pre-approved loan, and then scout for a property. That is an advantage, because then you know that how much money you can get in terms of the loan. And when you talk to the builder, you can talk with more confidence, you can negotiate better because the loan is already sanctioned for you. So I would always recommend that you take a sanction first based on your financial eligibility, and then with a sanction letter in your pocket, you are in a better position to hunt for properties and negotiate better with the builder. So yes, always go for a pre-approved loan. As far as what you should look at while applying for a loan, there are some important things that you must note. So what is your income? How much monthly EMI can you afford to pay? So the EMI amount needs to be fixed in advance so that you know how much you can pay. What is your down payment that you will be able to make to the builder while buying the property? What is the tenure of the loan that you're looking at, whether it is 10 years, 15 years? whether you want a fixed EMI every year or you want a step up or a step down kind of an EMI. Those are some of the important things that one must look at while applying for a home loan.
Okay, so those are the top things to keep in mind when applying for a home loan. We have another query from Rakesh Radia. He writes, I'm having one housing loan from SBI and claiming a tax benefit of 1,25,000 rupees towards the interest payment. This is a home that I reside in. I'm now planning to buy another home in the same town in which I will be paying an interest of around 2 lakh rupees. Can I claim the combined housing loan interest benefit for both the houses? Sanjay, what do you advise?
Payment of interest on the loan is an important consideration for income tax. As all people know, you can claim up to 2 lakh rupees on a self-occupied house as far as interest payment is concerned. And on the principal side, you get 1,50,000 rupees as deduction allowable for principal repayment of the loan. However, there are different rules for different properties. So if it's a self-occupied first property that you own, the limits of 1,50,000 on principal and 2 lakh rupees on interest apply. But if you buy another house, then that house and the interest paid on that is clubbed under loss on housing property. How do you calculate that? The entire interest amount that you pay for the loan of the second house, along with the property tax, the municipal taxes, etc. that you pay are deductible. Apart from that, if there is any rental income on that house, that needs to be considered. And if the house is not given on rent, the house might be considered as deemed to be let out. There will be a notional rental value that will be attached, from which the expenses will be deducted. However, in most cases it works out that the interest that you pay is quite high, and hence you are allowed a substantial and a handsome deduction against loss on house property.
Sanjay Athalye from Reliance Commercial Finance and Home Finance, thank you so much for joining us today.